If you're working in foreign exchange trade life cycle, clearing and settlement systems, then you would have come across the term CLS, continuously linked system. Let's learn more. I'm your trading partner, Sushila Hariharan. If you're interested in a career in investment banking, trade life cycle, corporate actions, and hedge funds, do subscribe to my YouTube channel where we provide content centric, research focused videos on these topics. Let's look at what is a foreign exchange trade. When you talk about the foreign exchange trade, which literally runs into $6.5 trillion every single day, we're talking about the interbank foreign exchange markets, where trades start from a minimum lot size of about $500,000 and then it goes upwards of that amount in corresponding currencies as well. So the interbank FX market is the largest financial market in the world, trading upwards of $6.5 trillion every single day. So if you look at a bank, let's say that is trading in USD euro, and let's say the bank has bought USD and has sold euro, right? That's the currency pair. So they've taken a long position in USD euro, which basically means they have bought USD and they have sold EUR, right? So over here you understand that there is a involvement of two currencies across borders, across countries, in different continents, right? This puts some bit of a confusion in the mind of the trader, because what would happen if they paid the euros for the dollar but they didn't get the dollars, right? So then that would be a real problem, because the bank is in a different country altogether, is in a different continent. It could pose not just market risk, it could pose settlement risk, which is a type of a counterparty default in markets. And that could mean that the bank has delivered the EUR but has not received the USD. Okay, so this was a large concern right up to a few years ago, because it posed a concern for the requirement of a solution for meeting the needs of mitigation of settlement risk. So this settlement risk in foreign exchange trades is called as Herstatt risk. A little bit of history to that it was Herstatt Bank, a German bank, which faced issues and it had to literally wind up its operations because of the settlement risk. But that is not the point. The point is, even in this day of digitization and movement and cross-border transactions, etc., multi-currency foreign exchange trades, we have to have a solution that looks at a system which is more about mitigating the settlement risk. Once the settlement risk is mitigated, the confidence of the trading partners to trade more increases more, right? I mean, once you see that 99.5% of the trades are going through, then obviously you'll feel confident, you'll feel a little bit more comfortable doing a foreign exchange trade, because you know that there is less of settlement risk, right? So to mitigate the settlement risk, CLS was envisaged as a solution. It, I think, offers now a multi-currency FX settlement in many currencies on a PVP, that is payment versus payment. So stock exchanges, follow a DVP, that is delivery versus payment mechanism. So this ensures that the clearinghouse of the stock exchange becomes the buyer to the seller and the seller to the buyer, and therefore the settlement risk is mitigated, because the stock exchange is then literally assuring that the trade will get settled and that there is no further settlement risk that is posed, because it has literally taken over the counterparty obligation. A similar such thing is done in foreign exchange. Okay, given that foreign exchange trades take place in different time zones, imagine a USD JPY transaction, right? In some parts of the US markets are fast asleep, right? When Japanese markets are trading, some parts of Western Europe are fast asleep, by which time Japanese markets are at the peak of their trading activity. So because of all these time zone differences, etc., a system was evolved called PVP, in which there is a payment versus payment against each other for the settlement of foreign exchanges, foreign exchange currencies in multiple currencies. This basically helps mitigate the settlement risk, and CLS is offered in multiple currencies across the world, and this system of PVP is unique to foreign exchange because in foreign exchange time factor is important, and second is the more important factor is the cost of capital, right? I mean, whenever you have nostro balances in the credit, then the holder of the nostro is actually giving you interest for that. So this means that cost of capital is also reduced, or earnings in the nostro account balances are maximized because of CLS trades. So CLS trades facilitate this large scale movement of foreign exchange transactions, and this enables the counterparties to the trade mitigate the risk for the same.